Welcome back. The cash flow statement can be prepared based on balance sheet and income statement items. In this lesson, we shall learn how to prepare the cash flow statement for CFO using the direct method and indirect method, the CFI and the CFF. Let's dive right in. In the first part, we've learnt the classification of activities based on IFRS and US GAAP. Herein comes the question: how are these items presented in the cash flow statement? There are two methods of presenting the cash flow statement: the direct method and the indirect method. The difference in presentation of the two methods only refers to the calculation of the cash flow for operations, or CFO in short. The presentation of cash flows from investing activities and financing activities is exactly the same under both methods. The direct method is to identify actual cash inflows and outflows, while the indirect method is to begin with net income and make necessary adjustments to get the CFO. Let's compare the two methods. Under the direct method, an accrual basis income statement is converted into a cash basis cash flow statement. Recall that under the accrual method of accounting, the timing of revenue and expense recognition may differ from the timing of related cash flows. Under cash basis accounting, revenue and expense recognition occur when cash is received or paid. So you can see, the revenue and expenses accounted for on accrual basis and the actual cash received and expensed can be vastly different. Conversely, you can also see the similarities of the income statement and direct method cash flow presentation. The direct method begins with cash inflows from customers and then deducts cash outflows for purchases, operating expenses, interest, and taxes. Under the indirect method, the net income from the income statement is converted to operating cash flow. This is done by making adjustments for transactions that are non-cash but affect net income. Such adjustments include eliminating non-cash expenses like depreciation and amortization, non-operating items like gains and losses, and changes in balance sheet accounts resulting from accrual accounting events. Total cash flow from operating activities is exactly the same under both methods. The primary advantage of the direct method is that it presents the firm's operating cash receipts and payments, while the indirect method only presents the net result of these receipts and payments. Therefore, the direct method provides more information than the indirect method. This knowledge of past receipts and payments is useful in estimating future CFO. The main advantage of the indirect method is that it focuses on the differences in net income and CFO. This provides a useful link to the income statement when forecasting future CFO. Analysts may find it easier to forecast net income and then derive the CFO by adjusting net income for the differences between accrual accounting and cash basis accounting. Companies often only disclose indirect operating cash flow information. Analysts, on the other hand, prefer direct format information. As such, analysts often approximate the direct cash flow statement from the available financial statements. We shall go through the steps to prepare the cash flow statement from the income statement and balance sheet. The first step is to determine the cash received from customers. From the income statement, we have the revenue. The revenue is the total sales made in the period. Based on accrual accounting, the revenue consists of sales made in cash and sales made on credit. On the balance sheet from the previous period, part of the accounts receivable was repaid by the customers during the year. The rest was carried over to the current balance sheet. What we're interested in the CFO is the total cash collections from customers for this period. This consists of sales in cash for the period and the accounts receivable that have been repaid by the customers for the period. This amount can be calculated by subtracting the revenue from the income statement by the increase in accounts receivable from the balance sheet. Plugging in the figures, we get a total of $99,000 cash collected from customers. The second step is to determine the cash paid to suppliers. From the income statement, the cost of goods sold gives us an idea of the purchases made from suppliers for the period. The goods sold during the period can either come from inventory or direct from suppliers. Therefore, if the inventory has decreased during the period, the decrease in inventory must have been sold if there were no write-offs. The balance must have been purchased from suppliers. Therefore, the purchases made during this period is the cost of goods sold minus the decrease in inventory. However, not all the purchases are made with cash. As with the principle of accrual accounting, part of these purchases could be made on credit. At the same time, some of the accounts payable from the previous period could have been repaid to the suppliers. The cash paid during this period is therefore made up of the purchases made in cash and the amount of accounts payable that was repaid. This can be calculated by the total purchases minus the increase in accounts payable, or the cost of goods sold minus the decrease in inventory minus the increase in accounts payable for the period. Plugging in the figures, we get a total of $34,000 paid to suppliers. The third step is to calculate the cash paid for operations. From the income statement, we have the sales, general and admin, which is the operational expenses made during the period. Based on accrual accounting, the SG&A consists of expenses paid in cash and expenses paid on credit. On the balance sheet from the previous period, part of the accrued liabilities was repaid during the year. The rest was carried over to the current balance sheet. What we're interested in the CFO is the total cash paid for operations for this period. This consists of expenses in cash for the period and the accrued liabilities that have been repaid for the period. This amount can be calculated by subtracting the SG&A by the increase in accrued liabilities for the period. Plugging in the figures, we get a total of $8,500 cash paid for operations during this period. You can probably see the pattern by now. The cash paid for interest is the interest expense minus the increase in interest payable for the period. Plug in the figures and we get a net cash paid of $0 for the period. The cash paid for taxes is the tax expense minus the increase in taxes payable minus the increase in deferred tax liabilities for the period. Plug in the figures and we get a net cash paid of $14,000 for the period. Summing up all the cash inflows and cash outflows for the period, we get a total operating cash flow, or CFO, of $42,500. Preparing the indirect cash flow statement is vastly different from that of the direct statement. We begin with net income and adjust it for differences between accounting items and actual cash receipts and disbursements. Depreciation, for example, is deducted in calculating net income but requires no cash outlay in the current period. Therefore, we must add depreciation to net income for the period in calculating operating cash flow. Proceeds from the sale of fixed assets are an investing cash flow. Since gains are a portion of such proceeds, we need to subtract them from net income in calculating CFO under the indirect method. Conversely, a loss would be added back to net income in calculating operating cash flow. Under the indirect method, we also need to adjust net income for change in balance sheet accounts. A quick way to remember polarities is to adjust for a decrease for assets and adjust for increase for liabilities. In summary, the steps in calculating CFO under the indirect method are as follows. Step 1. Begin with net income. Step 2. Eliminate depreciation and amortization by adding them back. These are expenses where cash was not dispensed. Step 3. Eliminate gains by deducting them and losses by adding them back. These are CFI items, not CFO. Step 4. Add or subtract changes to balance sheet operating accounts as follows. The presentation for CFI and CFF are identical under both methods. Let's look at how they are prepared. Investing cash flows are calculated by examining the change in the gross asset accounts that result from investing activities, such as plant, property and equipment, land, intangible assets, and investment securities. Related accumulated depreciation or amortization accounts are ignored since they do not represent cash expenses. Note that in this balance sheet, the PP&E is reported as net PP&E. The term net means it is net of accumulated depreciation expenses. This is the reason why we do not see an accumulated depreciation account on this balance sheet. As such, from the beginning net PP&E, a portion could be depreciated during the period, and a portion could be sold for cash. The remaining is carried over to the ending net PP&E. Throughout the year, new PP&E could have been purchased with cash. This goes into ending net PP&E as well. What we're interested in the CFI is the cash paid for new asset purchases for this account in this period. Over here, we can see clearly that the purchased new PP&E is the increase in net PP&E for the period, plus the depreciation expense, plus the cost of PP&E sold for the period. This works out to be the ending net PP&E minus the beginning net PP&E plus the depreciation expense plus the PP&E sold. Plugging in the figures, the purchased new PP&E for the year is $25,000. We assume all the payments are made using cash. Since the amount is positive, cash is paid to make the purchases. As such, it is a cash outflow of $25,000. Note that this is the case when we're working with net PP&E figures, where we have to add back depreciation expense, which is a non-cash expense deducted from the net PP&E. In the case of dealing with gross PP&E, we simply ignore the depreciation expense as it has not been factored into the gross PP&E computation. When an asset is sold, cash is received and this has to be accounted under CFI. Here we get a clue from the income statement that there's been a land sale and $10,000 gain is realized from it. We also know that as a result of this sale, the account for land has dropped from $40,000 to $35,000 during this period. Using this information, we can calculate the cash proceeds from the sale of the land. Firstly, we know that the account for land has dropped by $5,000. If there are no other purchases or write-downs of land during this period, this implies that the cost of the land sold was $5,000. So, if there was a gain of $10,000 from the sale of the land and the cost of the land was $5,000, the selling price must be $15,000. This $15,000 is a cash inflow and it is accounted under CFI as $15,000 cash from sale of land. In general, the cash from sale of an asset is the sum of gain or loss on the sale, plus the decrease in the asset account for the period. Totaling up all the items under CFI, we get an investing cash flow of minus $10,000. Moving on to CFF. Financing cash flows are determined by measuring the cash flows occurring between the firm and its suppliers of capital. There are two main groups: the creditors who hold bonds issued by the firm and the shareholders who hold the common and preferred shares. Cash flows between the firm and its creditors result from new borrowings and debt principal repayments. Note that interest paid is technically a cash flow to creditors, but it is usually included in CFO under US GAAP. Cash flows between the firm and its shareholders occur when new shares are issued, shares are repurchased, or when cash dividends are paid. Let's examine the statements for clues where financing cash flows has occurred. First, we observe that the bonds issued have increased from $10,000 to $15,000. This suggests that $5,000 worth of bonds were issued during this period. Since the firm received $5,000 cash from the creditors, we record this under CFF as a cash inflow of $5,000 from bonds issued. Next, we observe that the share capital has decreased from $50,000 to $40,000. This suggests that $10,000 worth of stocks was repurchased from shareholders during this period. Since the firm expended $10,000 cash to buy back the shares, we record this under CFF as a cash outflow of $10,000 to repurchase stock. The dividends payable is an accrual account that accounts for dividends declared but have not been paid out. The ending dividends payable for the period is the beginning dividends payable, plus the dividends declared during the period, minus the dividends paid out as cash. Under CFF, we are to account for the amount of dividends paid out for the period. Rearranging the equation, the dividends paid out during this period is the beginning dividends payable plus the dividends declared minus the ending dividends payable. The dividends declared can usually be found at the end of the income statement after net income. We're informed that the dividends declared during this period is $8,500. Plugging in all the figures, we get a dividends paid of $3,500. As this is cash paid out, we record this as a financing cash outflow of $3,500. Summing up all the items under CFF, we get a total financing cash flow of minus $8,500. Finally, total cash flow is equal to the sum of CFO, CFI, and CFF. Summing up all the figures, we get a total cash flow of $24,000. Notice that this is consistent with the net change in cash for the year. That concludes this lesson, where we learnt the mechanics of preparing the cash flow statements using the direct and indirect methods. In the next lesson, we shall move on to the financial analysis techniques that analysts employ using data from cash flow statements. See you again.